You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That funky tune means it's time for the funky program to wrap up our broadcast week here on the old Options Insider Radio Network. Yes, it's time for TWIFO, This Week in Futures Options. The name pretty much says it all. It's the show where we break down the week that was, and in many cases still is, from a futures options perspective. Could be volatility, could be skew, could be open interest, unusual activity, all of that good stuff. You never know who's going to make it on the show. That's why you've got to tune in. And spoiler alert, a lot of things are popping off today as a result of all things trade war. We're going to get to it. Of course, you guys can join us. No shortage of ways to do just that. You can consume the show at your leisure, really, if you want to join us live, if you're available every Friday, 1:30 p.m. Central. Love to see you in there. Mixlr.com is the place for that. Of course, if you want to subscribe, your iTunes, your Pocket Cast, Google Google Podcasts, whatever you like to use. Go forth, have fun, and prosper. And of course, you can always join us via the website if you want to go back into the archives, or indeed our mobile app and do a deep dive into the archives of the show. A lot of great content in there for you as well. Of course, however you listen live after the fact, hit us up. Questions, comments, insights, pearls of wisdom. Bet you guys are doing just that as we're broadcasting here. So we'll see how many we can get worked onto the show today. And to help me just make sense of all that's going on out here in the old marketplace today, our old friend here on the show has been on a little bit, but he's back on. He's Mr. Sean Smith, the Managing Director of Derivatives Licensing over there at FTSE Russell. Sean, welcome back to the TWIFO program, sir. It has been too long.
Hey, Mark. Happy Friday. Very excited to be here. Thanks for having me on.
I hope you got your talking pants on, sir, because we got a lot to talk about today. My usual cohort, Mr. Nick, taking some much-deserved vacation time today here, on assignment, shall we like to say here in the biz. So he's on assignment doing nothing, which I think is an assignment he likes to do. So Sean and I are going to tackle all the heavy lifting this week. Sean's ready to roll. He's going to be talking nonstop for about an hour. No, I'm just kidding. We're gonna make things fun. But before we even get into it, we got a lot of product categories. Sean, it's kind of a weird day. We'll get into the full equities complex in a little bit and kind of what's going on out there. But give us your thoughts. You've been traveling around. You just had the big Russell reconstitution. Again, we'll get to all that, the kind of the fallout from that in a little bit. But give us your thoughts right now. We're kind of in this weird market environment where we've been talking almost nonstop about this trade war. What impact is it going to have on volatility, on volume, on indices, on commodities, on all these different products? Products like soybeans and others have been taking a hit for months. And here we are now, the thing's actually happening. We're in an actual trade war. We announced it, China retaliating. And what's the market doing? The markets are rallying. Volatility is coming off kind of across the board. So it's kind of a weird, almost sell the rumor aggressively and then buy the fact type of environment. What are your thoughts on this kind of weird scenario you find ourselves in the market these days?
It's interesting times, and it's a very unusual market, right? You'd think that this type of news would put a big spark in big moves, but there's been so much talk, and it's so out there about what is going on and the explanations about what this trade war means. I think the news has been digested, and the volatility's been through a lot of it already. The fact that it's now here, the trade war has kicked off, with no surprise, right? We knew we were headed in this direction. So that's why I think the markets are reacting the way they're reacting.
Yeah, it's kind of nice.
Not to
Okay, good.
Not to just jump right into Russell, but small caps have really outperformed, and I think that the fact that they're it's a domestic index, the Russell 2000. I think a lot of this is a really exciting piece for that index. It's really interesting. So something to watch.
Yes, this is definitely a time for Russell to shine. We're going to get, in fact, it was brought up even on our last show. We were just doing volatility views of the Russell and kind of what's going on out there. So it is definitely a product category to watch. We're going to get to that in very shortly there, Sean. First, we got to kick things off. It is, like you said, trade war times, and product categories kind of across the board are moving quite a bit. So we talked about ags a lot of late. We talked about crude a lot of late. We haven't had gold on the show in a little bit. Let's get to gold here first. Gold coming off a little bit here on Friday, ending the week kind of almost unched, right around 12 double or so out there. So all this kind of sturm and drang about the trade war, not amounting to a whole heck of a lot, at least net on the week. For gold, again, we saw those tariffs kicking in, about $34 billion for Chinese goods coming in, another $16 billion, on Chinese goods, another $16 billion expected to kick in the next couple of weeks. China, of course, retaliating with about the same amount on our goods, and yet, in all this, of course, the dollar also lower. Usually a little bit of a bullish signal for gold, not so much. Here is kind of a lot of a confluence of events kind of weighing on gold. And again, net out the week with about unched from an OI or from a volume perspective. Also OI, again, we had a truncated holiday week here in the U.S. listeners, so volume's a little bit light. Gold OI actually only up about 1% this week, so interesting stuff. We've been talking about the gold vol story for quite a while as well. It's kind of been just a sob story for quite some time. Gold volatility holders have been kind of well. If you were hedging aggressively, I know Nick has expounded upon that. If you've been hedging pretty aggressively, you have done all right, and that's the case here. If you had premium but you hedged it and you kind of scalped it, then you did all right. This case though, vol continued to come in, spiked a little bit last week. We're off about a half a point or so from where we were last week. Again, where the trade war was looming out here in gold land. If you're saying to yourself, what is the hot call out there? Remember, we closed right around 12 double or so. What would be the hot call, hot month? If you had said to yourself the AUG 1290s, then you are a more prescient fellow than I, let me just say, because that was what was lighting it up, taking number one on our hot top 5 here in gold options today. About 3,000 contracts again. Kind of a quiet week, lighting it up. About 3,000 total contracts of that. A lot of that opening on Monday, getting the lion's share of the volume. Not so much today. About 2,000 contracts net opening out there. Let's see if we look. Let's just scan around really quick because it was kind of a light week out here. Gold-wise, let's just see if any interesting strikes. I mean, that strike alone was kind of interesting, 1290, I should say. If that's not far enough out for you, you want to go to Feb 2019, you want to go farther up to the 1600s, well, then we got you covered out there, too. About nearly 2,000 of those trading this week. All of that, again, on Monday. Slightly closing, a couple hundred contracts closing. So I guess a lot of back and forth on the 1600s with a little bit of a bias towards closing. And if you're more of a downside player, then 1140 puts doing about 2,000 contracts this week as well. Kind of the number du jour, the lion's share again on Monday. So yeah, got a bit of a all over the place here. 1600s, 1290s, and 1140 puts out here in gold. Worth noting on the vol side as well. Nick did chime in with his thoughts on gold skew, saying, gold's still kind of slogging along. Not much change overall in the vol space, coming off a little bit from last week. He did mention, though, that he thought the puts were a little bit softer, calls a little bit firmer. So, again, people coming in, hitting those puts maybe a little bit more aggressively, bidding up the calls. So, again, maybe some bullish risk reversals lining up out there. We shall see. At least that's what it's lining up out there from a skew perspective. Sean, I know you're not a precious metals guy, but is there anything out there, maybe silver, maybe in the other metals out there catching your eye in the metals complex before we move on to some other products, sir?
I watch the metals complex very closely, but yeah, I've got no insights that would help you listeners, so I apologize there.
Sean, I sent you the detailed gold in depth. No, I'm just kidding, of course. I'm just tossing you a bone here. Let's move on, of course, to all things equities, because that's kind of been one of the big stories here with the trade war, as equities have been moving. In fact, Sean, before we even get into all that fun stuff, we asked our listeners right before our last show, actually, so kind of a quick little flash poll. We asked them, where do they think, obviously there's been a lot of vol happening already as a result of the trade wars. But we asked them, now that the trade war is on, going forward, which of the product categories do they think is going to exhibit the most volatility as a result of this trade war? We gave them 4 choices. We said soybeans, gold, crude, or equities. Spoiler alert, going to probably hit all of those on the show today. Sean, what would your choice be? And then more importantly, what do you think our audience is voting for?
I got to probably say equities.
That's in your job description, right? You got to, I think it's required. If you said soybeans, you might be in trouble. You think that's what our audience is voting for too?
I would think so, yeah.
So far, I mean, it just went live. It's a short poll, so we'll see. These numbers might change, but a lot of initial response, and 43% saying soybeans in the ag, Sean. So kind of surprising out there. But again, not surprising. They have seen the biggest probably net impact overall as a result of the trade war just getting hammered. Coming off of that a little bit today. We'll get to that in a little bit. Crude oil, number 2, 36%. Equities, only number 3, 14%, and only 7% for gold. So if you haven't voted, get out there yet. You got a few more hours left. Again, it's a kind of quick flash poll. And I'll see these numbers are changed. They have been kind of holding pretty steady for soybeans. Equities, I'm kind of with you, Sean. I thought equities would get a little bit more love from our audience, but Apparently not. Let's go back to the love, though, a little bit. You guys just felt, not too long ago, about a week or change ago, with the big, or 2 weeks ago, with the big Russell reconstitution. We talked about it on the show, a lot going into it. It was an interesting time there, Sean. It's also a pretty active day. In fact, of the last 6 years, pretty much 5 of them, Russell reconstitution was one of the top 10 busiest trading days of the year. And this year's reconstitution pushed volume on all U.S. exchanges above 10 billion shares. That's well above the 2018 average of about 7.2 billion shares. So this year, again, Russell reconstitution is a huge driver. Whether you trade Russell or not, it's out there moving and shaking and making an impact in the marketplace. So, Sean, you've had a chance to relax. You had a chance to recover from your big day. Give us some of your thoughts on how it played out, maybe some interesting surprises and interesting takeaways that you saw from all this.
Well, here's a little quick bit of information about the recon. Just about 1.2 billion shares traded in less than the final second of trading on NASDAQ on the 22nd. That's 39.26 notional billion, $39.26 billion of notional value traded in stocks, and over almost 2,600 stocks traded in that last 0.935 seconds of the trading day. Really exciting, and it's clearly a record on the NASDAQ closing cross. It was a record by far. So very exciting day. The NASDAQ team was there in New York to ring the closing bell. Ron Bundy was there in force, and very exciting to see that.
Yeah, that's those kind of numbers are almost hard to wrap your head around. They're so enormous and they're so quick. I mean, you're talking about almost more than an entire day's worth of volume. Not too long ago, not in the far too distant past of the equities market, now being done in the fraction of a second over there, pretty much right around the close. So it's those kind of numbers. I saw those numbers. They talked about them, I think, a couple weeks ago on the show with all that the closing cross data and stuff. That it was just it's kind of hard almost to process that week, that show where the markets have evolved to in this day and age, to see so much paper going through, pretty much all automated and all done in a fraction of a second is a little bit awe-inspiring. I'm not going to lie. It's just something to see how much volume and how much the space has really evolved over the last couple of years. Well, you touched on it earlier in the show, Sean. I kind of want to get to it now because it has been interesting. Again, we brought it up on our last show, Vol Views, and it's a worthwhile talking point here because we are in this kind of weird market. We are seeing this space where the indices are rallying off of what is effectively some pretty nasty trade war data. Again, as you mentioned, some of this has been baked in already, but we're seeing a strong rally out there in Russell again today, and that's kind of been the one. It's kind of dancing to its own tune for the better part of the last few months, as you kind of mentioned. The big indices, S&P, certainly very, 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 very affected by the broad trade war issues. They make a lot of their money overseas, capital, all these other things. It's going to impact them. Whereas Russell 2000 is primarily small caps, so it's going to be not quite isolated, but more insulated from all these kind of growing macro waves we're seeing out there. So it's kind of an interesting story to watch. We're seeing it playing out now with Russell kind of outperforming quite a bit some of the other indices over this period. Also from a vol perspective out there too, it's kind of been interesting to watch. We mentioned before, small caps are pretty much just structurally a lot more volatile than their large cap counterparts. Just think of it. It's kind of the nature of the beast there, listeners. And we're seeing that play out now. Even though vol is still coming off, we're still seeing RVX, which is the Russell VIX, pretty firmly bid compared to VIX Cash. VIX Cash right around 13.5. Coming into the show, RVX was about 16.15. It's coming off a little bit now. It's about 2.25 points north of where VIX cash is right now. So it's kind of rustling in this range, about 1575 right now, kind of hovering in this range of about 2.25 to 2.5 points away from where VIX is. So in this time, summertime is the time when we hear this complaint a lot from a lot of vol traders out there. There's no place to find vol, particularly in the equities. Equity vol is eroding. Coming off a holiday week where usually vol is not really to be found in a holiday week. This one's a little bit of a weird one because we had the whole trade war swirling. But it has been interesting to note that we are seeing a lot of interest, a lot of action, and a lot of life still out there in terms of Russell. So that RVX VIX spread kind of hovering right around a 2.25 out there right now. I know we talked about it before, Sean. That kind of spread is an interesting one. A lot of people like to watch. And when it tends to get a lot wider, is that kind of what you see when you see as a big driver for a lot of customer paper out there in Russell land? Is it when that kind of RVX VIX spread really widens? Or is it also maybe, you've been talking to customers for a while anecdotally. Are they also starting to maybe start looking at Russell just because of what we're talking about earlier, about this kind of a little bit of insulation factor from the trade war? I'm assuming there's a lot of big institutional paper out there that's kind of done with this. They don't want to have to deal with this. So if there's a product out there that could maybe shield them from some of that impact, that might be an interesting thing. So maybe which of those are you seeing for drivers? Are you seeing, is it the vol spread? Is it the interest in small caps? Maybe a combo of the two? What are you hearing and seeing anecdotally out there from the institutional clients?
I think you're nailing it on the head, Mark. The fact that the Russell 2000 is pretty much domestic, and you used a great word there, insulated. Insulated small caps. They're insulated from all the geopolitical, the trade war stuff going on. The small caps exposure. Also, small caps are positive because of the recent tax reform that we've had recently. There's increased deregulation. The U.S. economy is doing so well, and the fact that these are they're all U.S. stocks, right? So it's just poised for growth. The Russell 2000 is poised. So these are all nice tailwinds that are really pushing the companies within this index to greater higher prices, right? So I think that's why Russell 2000 so far this year has risen 10% relative to 4.25% of the large cap stocks, right? So it's a tremendous story, and I think people are focused on it as well. But again, volatility comes in and rallies. So from an options perspective, I think everybody knows that. But in this situation, the outperformance of Russell 2000 has so many more people watching. A couple other things to mention. CME has over 17,000 unique traders of this product out there. They're averaging over 140,000 contracts a day right now in the futures contracts as well. So, and that's just growing and growing. Open interest is north of 500,000 futures and options contracts as well. And the RUT product at CBOE is busy as well. The product's doing great. So I think between the two exchanges, the products, one, are getting the exposure out there because of the performance of the index, but also there's just a lot of what I like to call cross-pollination. The products trade off of each other. So it's really exciting to see.
It's funny you should mention exposure. Maybe no small part of that. We're talking about it on the show here every week, but I will say anecdotally, we are getting hit up with a lot more questions and just general commentary on Russell than I can ever recall before. Part of it, of course, is because we're talking about it on the show here every week. But also, I think just in general, people are starting to discover what you're just talking about, when we've been talking about for a while, when the volatility story, and indeed just a lot of people out there just don't want to have this trade war thing buffeting their portfolio as much as it is. So this is a place that a lot of them are moving. In fact, I'm going to cheat. I'm going to bump up one of those questions right now. I was going to save it for the mail block, but it kind of just came in and it kind of caught my eye. This one's from D. Booker. I think he's listed in live here. D. Booker, and a whole string of numbers after his name. I won't go bother reading out all those. He's writing in about a lot of people looking at different ways to kind of express that viewpoint in the Russell, Sean. In particular, D. Booker wants to know, he says, have you guys seen these way out of the money calls going up on an ETF on the Russell, which is FAS. He said they're getting a lot of action today in out-of-the-money calls, and he lists a bunch of them in July and the 13th of weeklies, 13th of July and 20th. This one, of course, if you're not familiar with this one, listeners, this is actually a 3X bullish Russell, so it's a highly levered one. So if people out there want to express their viewpoints on Russell and they're interested and they're bullish in it, clearly you are for a name like this. That's kind of where they're looking at it. And this is the name that doesn't do a ton of paper, about 6,000 contracts a day. Actually, not bad from an odd block perspective, doing way more than that, about almost 7,000. And D. Booker is right. There is a lot of paper coming in. The FAS is hovering right around 64.5 right now. So anything north of that would be size out of the money. We're seeing weeklies in the 65s and beyond, 66s up to almost 1,000 in the 68s, again, in the weeklies in the very near term. So people are looking and interesting, and we talked before about the options volume we're seeing on the E-mini Russell as well over there in CME. So looking at all this paper, if we see the paper out here as well, it's kind of bullish in the weeklies in Russell as well. On the CME, it closed, or this week kind of coming into the show was a little bit shy of that 1,700 level, 1,695. We're seeing upside calls, kind of the story out there as well. 1730s going up this week, 715s kind of across the board. So it seems to be the case, Sean, just looking at the paper we're seeing in the ETPs and indeed on the broad E-mini Russell options themselves and a lot of the other ones out there, that the narrative is in, that Russell is kind of the place to look for some outperformance here. And we're seeing paper backing that up. Is that surprising to you, Sean, or is that kind of maybe what you'd expected, given kind of these macro trends we were talking about earlier?
Exactly what I expect. There's many reasons why they're buying upside calls or and selling upside calls, right? So there's buy rights, there's upside directional trading, but I am not surprised at all at the recent activity, because there is that major focus on small caps right now, and it's exciting. As I think I mentioned before, it's exciting to see. But again, the fact that it is that great word, insulated kind of index. It's going to be a focus, and I think the performance so far this year it's speaking for itself. So,
yeah, it has been an interesting one to watch, and interesting stuff out here, nonetheless. And you guys are hitting us up about it, so keep those questions coming. We can even see if we could cheat every now and then and squeeze them up into the main body of the show here. We got some more questions coming up in a little bit here in your futures options feedback. Got to hit on a couple other product complexes I know you guys are super interested in as well. It's been another crazy week for crude, ending up the week actually kind of not that unched, a little bit shy to the downside, off about 0.5%, but not quite maybe the big turbulent week we would have expected, given what's going on out there in gold. On the week though, gold going on the trade war. Net on the week though, vol-wise has been an interesting one to watch, because crude vol has been creeping up again. It's coming off a little bit today, but in general, over the course of the week, it's up about a handle and a half in some cases, sometimes two in the nearer term contracts. So a lot of interest out there in the vol, in all things crude. OIY again, another kind of slight week from overall crude. If you're looking though at where the action was, again, we settled out right around 74 handle coming in to the show. So if you're looking at what the paper was looking at this week, it was downside hedging on, protecting against near-term downside. It was indeed the AUG 70 puts that were lighting it up out here this week. Nearly 19,000 contracts going up. Pretty much half today, half Monday. That's kind of where the action was. So OI numbers a little bit misleading, because a lot of that paper going up today. But the 70 puts were where the action was. So people bracing for, protecting against that break to the downside out there in crude. 71 puts also lighting it up, doing about 14,000 contracts. The lion's share actually coming today. So people looking for a little bit more, a little bit closer, a little bit nearer to the at the money puts out there as well. It's kind of been a put show out here most of the week out here, looking for some funky paper that can go along with any of that. If you like out here long-term We talked about these last week, too. Someone out there is playing in very, very long term, Dees 2021, pretty far out of the money puts. In this case, the 45 puts going up about 1,300 times this week. Also worth noting the double puts out there in March, lighting it up to the tune of about 2,000 contracts as well. So it's not all calls, or should not all near-term puts. It's longer-term puts as well. So maybe the crude bulls taking a little bit of a break out here this week, at least from an options activity perspective. Worth noting, Nick kind of chiming in here on crude skew again. Not much change out there in crude skew. The vol is up, though, like I mentioned, on the week. And all worth noting, too, he had some comments about the Russell 2000 skew. We saw a little bit of a change from last week. Calls getting a little bit more offered, he saw in the skew-wise and puts bid, which is kind of interesting because you think might expect so the opposite from some of the paper we saw lighting up out there. Could be, again, maybe some overriding, as Sean was alluding to earlier out there on the upside. But that is a bit of a change from last week in terms of Russell skew. And interesting, also worth noting, we are lower on the vol curve. Vol is in from last week when you're talking equities, at least. So again, that could probably come more from just moving down the vol curve than anything else. As you move down, it's going to get a little bit juicier. So I would probably lean that way, again, talking Russell, than I would out there just people bidding up puts and crushing the calls out there. In all things equities. Touched on crude, by the way. I can't move off of crude. We like our silly predictions out here. There's another big one coming out this week in crude from this Fern Bernstein out here saying that they're predicting a super spike in crude prices well north of $1.50 a barrel. They're saying the underinvestment out there in all things crude in terms of long-term production is going to cause this super spike, potentially, they say, much larger than $1.50 a barrel. They're saying, the investments in these firms are the lowest in a generation. The reserves we have that will last have shrunk since the year 2000. So if there's not more long-term investment in production, we might see a super spike, according to this firm, at least. So if you're kind of paying attention to our predictions here on the show, at least not ours, but research predictions out there, we saw that crazy one from Citi, I believe, a while ago, saying between 35 and 75 crude. I think they've widened that out since then, and now we're seeing a super spike potentially coming in the near term for up to 150. Certainly not seen that playing out, at least in the options this week, but we shall see. One more before we move on, some more of your questions out here as well. Got to go to the ags because they've been lighting it up. In fact, if there is one product category that is really kind of the crux of the trade war, it is soybeans. It's kind of where the rubber, pun intended, meets the road, or the soy in this case meets the road. That's kind of been the big issue of our trade. A lot of the tariffs dealing with that, and the impact of that we've seen playing out over months now, where we've seen soybeans just taking a pounding. Finishing this week actually up about 20 handles net on the week, right around the 880 level. Remember, they were at the par level, the 1,000 level, not too long ago. So soybeans have taken a beating. We saw a little bit of a bump there, as maybe people are saying this is the near-term bottom. People have also been saying just the prices are getting so hammered here versus overseas versions of soybeans that it's just getting cheap enough. People want to come buy it. So maybe a little bit of a near-term floor that, of course, will please some soybean, I should say, bulls out here. Again, this has kind of been a big showdown. A lot of the showdown has been over the ag tariffs here. This is also a rough time. This is when a lot of the farmers are selling their beans to China. So having these tariffs hit now is kind of almost a bit of a 1-2 punch for a lot of these guys. They're saying China has purchased about 2.5 million metric tons, again, on futures here, on forwards, but they expect that might be canceled. These get canceled a lot. So that would not be a good thing, obviously, for the farmers. We also saw a bit of a ramp up going into these potential tariffs. We shipped a lot more beans in May than everyone expected, just because everyone was getting ready for a trade war. So get them out now. That also didn't help with the prices here. So exports jumping by about 2 billion from May to April, as I should say, April to May. So a lot of impact. People trying to get in ahead of these tariffs, also expecting to see exports again dropping sharply as these tariffs kick in. Let's see what we saw out here from a vol perspective. Not surprisingly, vol continuing to creep up out here in soybeans, up pretty strongly across the board, about a handle and change in some areas. Also worth noting, open interest decent, about 3.3%. Again, it was a truncated week. And what we saw out here with the beans, we closed well shy of that 1,000 mark, 880 or so to be precise. But where the action was actually in the AUG par calls, nearly 10,000. Lighting it up again, mostly a Monday. Not too much going up today. So that was our number one with a bullet trade out here in the soybeans. Worth noting, about a little less than half of that, about 4,100 opening on the week. So opening positioning back at a level we were at not too long ago. Remember, we had the Acuna guys on. They were just talking about breaking through the par level to the downside. So that not too far away in the distant memory, at least near term. Could be seeing some interesting opening bullish paper. Could be overriding as well out there on the far upside in the calls. Also saw 9/2 getting some action, about half that level, about 5,000 contracts going up. Again, most of that on Monday. A little bit closing, actually, slightly closing. So we don't have, obviously, today's numbers in tune for open interest, but still, 950s, 9/2s, and par calls are kind of where the action was out here in the beans. Also, we got to jump out a little bit. Not all calls, though. There was about 6,000 of the 920 puts going up out here in, where are we here? Going up out here, yeah, in these, right about November contract here, about 6,000 contracts, about lion share actually going up on Monday, about 5,500, slightly closing there as well. So 920 puts getting a little bit of action out here as well. So it has been an interesting one to watch out here in terms of the story. We shall see. You know, it's not a lot we know firmly yet. People are still waiting and seeing out here, and with the paper, a truncated week is kind of hard to make a lot of headway out there in terms of all things ag. But again, this is the story that's not going to go away as we continue to see pretty much the crux of all things trade war these days is in and around that ag complex. So we'll see that. And wrapping up really quickly, it's been kind of a rough few weeks for all things crypto. This week, not so much. So today, at least, up about 40 handles, back over that 6,000 level in the big Bitcoin contract on CME, about 6,500 right now. Doing about 2,000 contracts today, so that's about 10,000 when you get the multiplier factored in there. So pretty active day out here. All things Bitcoin and crypto. Again, oh, by the way, I forgot to plug it at the top of the show, but you guys can follow along with us here on the show via cmegroup.com/TWIFO, TWIFO. And if you do that, you could see all that good stuff, including what I like to call the movers and the shakers for the week over there on CME. They trade a lot of products. Sean alluded to it earlier. They trade a ton of products over there, and they tend to move quite a bit. So, and it's been an interesting week. We mentioned kind of all things trade war being a big driver for action. But let's go take a peek really quickly here and see what the big movers and shakers were for the week. Again, this is just underlying futures for the week. This is not vol or anything else. Lean hogs just taking on the chin this week, off about 23%. That's a pretty impressive number. I'll have to check into that one, make sure that's not an outlier there in terms of data points out there. But taking a drubbing, again, the ag component and the livestock. Feeling the heat as a result of this trade war. Then we get to a more realistic copper, number 2 of the dark side, off about nearly 5%. Class 3 milk, number 3, off about 2.6%. Nat gas, off about 2.5%. So that's our bottom 4, bottom 5, rounding it out. Iron ore, off about 2.3%. To the upside, we got euro dollars up about 10 to 11, 10.8%. Again, so maybe some outlier data kicking in there as well. Number 2, our old friend, the E-mini Russell 2000, up about 3% on the week. So we're talking about the outperformance data. There we go. There it is in stark relief. Number 3, the wheat to the upside, up about 2.5%. Number 4, the NASDAQ 100 E-mini, up 2.25%. Round out the top 5, actually getting a little bit of a bounce towards the end of the week, was the soybean meal, up nearly 2% on the week. That's going to do it for our movers and shakers. Now it's time for you guys to move and shake us with your questions. It is time for your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody. Welcome to the Futures Options Feedback. This is the portion of the show where you guys take the reins, questions, comments. I cheated. I bumped one of them up already talking about upside calls in the Russell. A lot of you guys got trade war on the brain. Go figure here, commenting, sounding off on all things trade war. Trade the swing, commenting, saying, today is sunny as trade tariffs begin. Yesterday was cloudy as trade tariffs were about to start. Tomorrow will be hot weather because tariff wars de-escalate. All this tariffs noise is beyond silly. I know a little bit of poetry there, Sean, for us from our listeners. Not quite a limerick or a haiku, but it's a haiku. It's interesting nonetheless. Our listeners, Sean, getting a little bit literal here, or poetic, I should say, waxing poetic on all things trade war. Does it warm your soul,
I
sir?
like it.
You like it? Maybe we should put out a contest where who can have the best trade war inspired poetry. I have a feeling it might get a little heated, so maybe that won't be the best. Maybe that won't be the best contest. Nonetheless, our listeners continue to regale us here. Son of the Algos saying hashtag buckle up, hashtag trade war, hashtag no MAGA, which of course make America great again. Just massive debt, shrinking system liquidity, and Trump plunging the West into the dark ages. Okay, getting a little political there. As everything trade war tends to do. So let's move on from that one. How about this? Let's go. We just talked the upside in Russell. Here's an interesting one, Sean. This is a kind of discussion Nick and I have been having on the show almost since the beginning. It's kind of an interesting one. Your product, Russell, is probably one of the few that's somewhat insulated from this because the weeklies are kind of where the action is now from the equities perspective. So I kind of exempt Russell from this topic. But this is a comment from Leveq. He writes in saying, I agree with your other listener that it's the brokers that are putting the brakes on the weeklies. I don't even see them listed on my platform. What the heck? This is the topic we've been talking about for a while. If you look at a lot of products, particularly a lot of the commodities, you see this in crude, gold to a degree, and others. You see a lot of paper, even in the ags. You see a lot of paper in the very near-term front month contracts. They'll trade the front month all the way down until the day it's going to expire. So they clearly will trade very short duration contracts. And yet, for whatever reason, the weeklies that are listed around that contract, that front month, they just don't touch. They'll do tens of thousands of contracts in the monthly. The weeklies, a couple of hundred. It's just a weird thing. It would make sense to me if people weren't touching anything near duration. They were all longer term, these products. Then it would make sense. They're just averse to that part of the expiration curve there. But they're clearly not. They clearly will trade these things. So it's got to be something functional. We had a listener write in, I think last week, I think he was saying he used TT, saying that he thought the problem was it's the brokers and the platform providers. Like for TT, for example, they said you have to kind of request the weeklies to get the weeklies on your screen, and it was a whole process. They, to their credit, responded and said they're looking to fix that, so hopefully that'll be the case. But I kind of think that's the case, Sean, with a lot of these brokers and providers, that you have to do something extra to get access to the weeklies. It has to be something like that because, again, otherwise you think people would be trading these things. And it's kind of nice from your perspective, I think. Your products, for whatever reason, maybe they're displaying the weeklies correctly. I don't know what it is. People are certainly not afraid to trade Russell in the weeklies. But in the commodities, it's kind of weird. I don't think I've had a chance to get your opinions on this, Sean. Why do you think it is that Russell and the equity products will kind of just live in the weeklies now, whereas a lot of these other commodity products, they haven't really caught up yet?
The shorter duration of the product is a very exciting one, especially in the index world. As you know, options decay the fastest right prior to expiration. So these shorter vehicles, to have that exposure and to have that accelerated decay just adds to the fun of trading them. So I think that's the real reason.
Yeah, you don't think it's something like systemic? I mean, that's keeping people like, let's say, like they'll trade a Russell weekly, but for whatever reason they won't touch a WTI. You don't think maybe something's keeping them from like seeing that on their platform? Maybe.
I'm thinking Main Street investors, watch the stock market more than they watch crude. I mean, they watch crude oil, of course, and they're very interested in the price of the gasoline that they buy. But from an investor community, I think the stock market still has that brand for the trading community on the retail side, anyway.
Yeah, that's clearly what it is. Clearly that exists. Obviously, I still, and I've asked just about everybody I could think of. I've asked vendors, I've asked people at the exchanges like CME, I've asked brokers and others what their thoughts are, analysts, traders. Everyone has kind of given me different answers for why they think this situation exists. I'd be curious, listeners, if you're listening to this, what platform are you using, and is it easy for you to see the weeklies? I mean, outside of like a Russell or the S&P E-mini, which clearly you guys are trading, do you have to do something special to do something like to see the WTI weeklies or the gold weeklies or ags or whatever it is you're trading? Let us know. I'd be curious to see what your experience is. I think there's something there going on that's making it hard for people to see these products because they're trading short duration. They're just not trading the weeklies themselves. I think it's got to be something systemic to it. But I think we're closing in on the answer to our holy grail quest here on the show. It's just why no love for so many of the weeklies beyond things like the equities. All right, let's see what else we got here. Here's a good kind of 10,000 foot question here, Sean. We can kind of sink our teeth into a little bit. This comes from Desmond. Desmond wants to know, what is the one thing you think people really should know but don't about the differences between futures options and equities options? I'll go first, Sean. I'll give you time to ruminate here. This has been a topic we've kind of wrestled with from the beginning on this show. It's kind of one of the reasons this show exists, is to kind of highlight those myriad differences out there and also similarities. So maybe they won't be as intimidating to you if you're looking to trade something like a WTI or a Russell or a soybeans or whatever the case may be from an options perspective. The one thing I think people have a trouble encountering, usually when they're coming to these products, they're usually coming, like Sean alluded to, they're coming from the equity world and the equity options world. So they're used to a certain volatility setup. They're used to a certain skew, which is usually referred to as investment skew. The calls are bid, the puts are offered the calls are offered, the puts are bid. Getting a little backwards there. From a volatility perspective. And that's kind of the way they see the world, because that's the way most equities and indexes have skew priced in. And then they come over to the futures options world, and it's a different beast. You get outside of the Russell indices and the equity indices out there, you get into things like WTI or gold or soybeans, and those skews are kind of moving all over the place. They're very different, and they're depending on the paper flow out there, what's going on with the underlying product. Gold's a good example. That skew could change very dramatically from one week to the next. It hasn't changed too much of late, but that's one where all of a sudden you see a big upside tier, and the calls are super bid, and then it's plunging to the downside, and now the puts are bid, and then it's kind of vacillating, and kind of both are kind of equally bid, and it can move all over the place, and that's fascinating for me to look and to analyze. I think it's a little bit intimidating for people coming over who are used to having a certain setup, because it's going to change the way a lot of their favorite strategies perform. How does a covered call perform in an environment where the puts, where, all of a sudden the calls are super bid, and now the puts and calls are bid the same, and now the puts are bid? How does that change how your covered call is going to perform, or your collar, or your vertical, or whatever your strategy du jour is? It's going to change. And so understanding that and wrapping your heads around that before you dive into the futures options world is probably an important step. Hopefully one we've helped you with here on this network and indeed on this program. But that's, I think, is the one thing a lot of people still don't really realize when they're coming over to these products, is just how different they are from a volatility skew perspective. And if you have a couple of certain barrels of tricks you like to go to all the time in your portfolio or in your options trading, you got to figure out how those are going to work in the new products you're looking at out there. So it's an interesting one, and one that I don't think people have maybe fully grasped yet in the futures options world. All right, that's a long way around, Sean. I hope I bought you enough time there. What would you have to say to our friend Desmond? He wants to know, what's the one thing you think people really should know about the differences between futures options and equity options, but they just don't?
I didn't hear you answer the question the way I was going to answer the question, and mine is really simple. It's let's just take the Russell, for example. Russell options on futures expire into futures. The RUT that trades on the CBOE, which is the equity option that trades at the CBOE, is cash settled. So, and one's CFTC regulated, one's SEC regulated. The CBOE's SEC regulated, right? So there's two. One's the options on the index. The CME's products are options on the futures and expire into futures. So I think that's the biggest difference for Desmond. I hope that's what the question was he's asking.
Well, Sean, that music means you did it. You survived. Well done. You made it all the way to the end of the show, sir. And you're right. Well done. You know, I kind of, expanded upon the more esoteric, top level stuff. But you're right. The underlying is the thing people wrap their heads around too, or have a hard time doing that. If you have cash settled versus expiring into stock versus expiring into a future, it's a very different beast. So there's a lot of things that people have stumbling. I guess we can all debate for ages what the biggest stumbling blocks are, but those are probably two clear ones most new players in the space have to wrap their heads around. What the heck's the underlying? What's my options are going to do? Are they going to settle into this? Are they going to settle into cash? What's the deal here with these underlying? So a lot to unpack. Good question there, Desmond. If you have questions like that, a good place for you guys to head over is to the CME Institute. Find that at cmegroup.com. While you're there, you can always go to cmegroup.com/TWIFO to see what's cooking over there in the realm of all things that we're talking about here on the show. If you want to see the ags for yourself, you want to see the skew, you want to see the gold, you want to see the Russell, whatever it is you want to look at, cmegroup.com/TWIFO is a place to kind of get your free taste of all things quick strike. And if you want to upgrade, you want to go full on to the dark side, the full power of quick strike at your disposal, one place for you to go, bantix.com, BANTIX.com. And then click on there, click on sign up for Quick Strike, and you're pretty much off to the races. Quite frankly, if you're trading these products and you're not using it, I don't know what you're using. There's not really anything else out there for you to use from an analytics perspective. So it's kind of the only game in town. So hopefully you're using it, at least kicking the tires and checking it out, because it's a very useful resource out there if you want to dive into the world of these products we're talking about here on a weekly basis. And before we go, Sean, you kind of just had your big reconstitution, so you can kind of breathe in, take a deep breath, relax. Now that that's done, what's on your radar? What's on your horizon? What are you guys working on the options team over there at FTSE Russell? What can we look forward to coming down the pike from you guys?
We're really busy with our partner exchanges, CBOE and CME Group. We're about to have our 1-year anniversary of the business transitioning to CME Group in July, on July 10th, So we're very excited that our partnership with CME is going as well and beyond all our expectations. We're very happy with the growth in the product. We're very happy with the global reach of the product. Things are really exciting, and I'm just really, really bullish on the product's growth trajectory, and we just have a phenomenal partner within CME Group here. So we're very excited about this 1-year anniversary of the transition of the business over to CME. So,
well, there you go, Sean. And the options paper is clearly backing you up. People are bullish out there on Russell as well. So it'll be an interesting one. We'll look forward to checking back in with you next week to see how all things Russell unfolded over the week. And on behalf of Sean and my buddy Nick, who's out there enjoying a little bit of a vacation time, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for listening live, all the fun stuff that you do. Keep those questions coming. We love to hear from you guys. And we'll see you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by Quick Strike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.